Good afternoon, folks. My name is Joe Bloodgood. With me today is my partner, Nathan Faith. We're with Boulay Financial Advisors. We're excited to be with you. Today, we're going to be looking at the cost of home ownership. We're going to look at that from a couple of different perspectives, both from a younger person's perspective and also from the perspective of somebody nearing or in retirement. And we hope you find this helpful. Nathan, how are you?
Doing great, Joe. Thanks. So where we start with the cost of home ownership is really a breakdown of what it really costs per year to own a home. And we've used the measure of the value of, say, each $100,000 of home we buy. And then we can measure really what it costs us per year to buy a home that's some multiple of $100,000. And so where we start is the more known and obvious costs of home ownership, really the mortgage. And so historically, over the last 10 years or so, mortgage rates have averaged about 4%. And mortgage interest is really rent to the bank. It's the cost of borrowing money. And at 4% on $100,000, that would cost $4,000 per year to pay the interest portion of the mortgage. But as we know, part of the mortgage is paying down the debt. And so on a 30-year mortgage, each year we pay down about 2% of the mortgage, or $2,000 per year for every $100,000 of home we buy. Now the banks oftentimes roll in other costs that they need to ensure are taken care of to protect their risks. And one of those is property taxes. So here in the metro area of Minnesota, property taxes average about 1.5% of the value of the home. So per $100,000, about $1,500 a year. And then of course, insurance, which is about half of 1% of the value of the property. So $500 per $100,000. Now remember this green area, this 8% that we've added up so far, this is what the banks focus on. But of course, as homeowners, we have additional costs, and it's important to factor those in when we're budgeting for our home purchases. And those other costs are really living comfortably within the home. So utilities, water, trash, gas, electric, internet, they add up to about 1% of the value of the home per year, or $1,000 for every $100,000 of home we buy. And we don't want to forget about maintenance. Maintenance for a relatively well-maintained home is about 1% of the value of the home each year, or another $1,000. Add these all up, and to stay within a home through good economic times and bad, it costs about 10% of the value of the home to pay all the bills, or $10,000 per $100,000 of home we buy. We'll reference this, but remember, the banks are only looking at this first 8% and ignoring this other 20%. And that actually carries on to how to right-size our home's value for our financial plan and really our financial priorities. So Joe, do you want to speak to that?
Yeah, absolutely. So let's talk a little bit more about what an affordable home actually looks like. So if you have no other debt, 28% of your income can be spent on housing. Now, when we think about how banks will typically do that calculation, if you remember the last slide that Nathan just spoke to, they're really focused on that 8% that he mentioned, not thinking about the utilities and maintenance. So when you do that, when you look at that number, that 8% divided by the 28% of your income, you come up with a figure that's about 3.5 times your income. Okay. So if we think about, okay, that's what the bank is saying, and keep in mind that banks are incentivized to loan us money. That's how they stay afloat. But contrast that with a more conservative calculation where we include that extra 2% to look at what we think is the actual affordable calculation. And so if you change that 8% into 10%, divide that by the 28% affordability factor, you come up with about 3 times your income. So on a $100,000 of income, right? That's a $300,000 versus a $350,000 home.
And to carry that calculation forward, with the example of $100,000 of income, At the top end, banks would lend us $350,000, which would cost $35,000 a year after taxes. That's money that's coming into our checking account after we pay taxes in order to pay for our housing expenses. So for many of us, we have to earn $50,000 in order to pay $35,000 in housing expenses. But if we look at our affordable calculation, what are we really doing? We're trying to set financial priorities of paying ourselves first. So setting aside our savings before we identify how much we can afford to spend year by year on our living expenses. So there's a number of metrics to look at what's the right percentage of your income to save. We've identified a couple that's relatively young that would like to retire relatively young, and so they prioritize their savings as being a fourth of their income, $25,000 a year, which leaves $75,000 of remaining income or net income to then apply towards paying for everything else. And so our calculation picks up on that green portion, and we multiply that $75,000 of true, call it true discretionary income to identify affordable home that fits within one's financial plan of $225,000 instead of the bank's calculation of $350,000. The difference in the annual cost is $12,500 a year, and that's enough to maximize one's 401k each year if we factor in the tax savings that can be experienced by putting that $12,500 to work and getting a significant tax deduction at the same time. So what about those of us who are approaching or near retirement? How do we right size our home as we transition to living exclusively off of our own wealth? One major difference of being in retirement versus accumulating wealth for retirement is a significant portion of our budget savings falls off our budget. We no longer need to save any longer for retirement because we're in it. So the key factor is now to identify how much income do we really have that we can rely on in order to pay for all of our expenses. Well, there's really two types of income that we focus on in retirement. The first is income that we can reliably draw from our portfolio. So there's a tried and true rule out there called the 4% rule that's really designed for those who have the unfortunate luck to retire into a financial crisis, a Great Depression. What's the maximum they can spend each year and not run out of money starting day one? And 4% is the answer that historically has played out. And that's 4% of really what we have saved. And we'll talk to that in the example here shortly. And secondly, layered on top of that are fixed income dollars that come from accounts, resources that we've worked hard for, but are outside of our control. So for instance, most of us have Social Security checks. Some of us even have pension checks. And those figures, we know what we're going to be paid year by year. And we can simply start identifying what those paychecks really look like. So in this example, we're showing a married couple in which one spouse is eligible for about the maximum Social Security benefit at what we call full retirement age, so about age 66. And the other spouse is eligible for the minimum Social Security benefit. All told, about $40,000 a year between the two of them. And then we look at their nest egg. What do they really have saved up? In this example, we assume they have $1.5 million to their name amongst their retirement accounts and brokerage accounts. And 4% of $1.5 million is $60,000. That's what they could sustainably draw from their portfolio each year for the rest of their retirement and give themselves a cost of living adjustment each year. All told, between their Social Security checks and what they can sustainably withdraw from their portfolio, they can be confident in spending $100,000 a year. That figure we can now multiply by 3, like we did before in our affordable housing calculation, and identify that a right size home for their financial plan is $300,000. And the annual cost of that home would be about $30,000 a year, which ironically aligns well with the bank's calculation that no more than about 30% of our income should really be going towards housing costs. So these two calculations, the first being for those of us who are in the accumulation stages of our lives, and the second being for those who are in the distribution phase of our lives, really are the key to financial success. This 15-minute video could potentially make the difference between us being millionaires next door or struggling to keep up with the Joneses and waiting for each paycheck to come in order to meet the next mortgage payment.
Thanks, Nate. I think that was really helpful. If anyone out there has questions about this or any other thing that might be affecting their retirement plan, please don't hesitate to reach out. You can email us at learnmore@boulaygroup.com. Again, learnmore@boulaygroup.com. Thank you.